It can be scary when an investment you make heads south and puts you in the red. Often, this is when investors become overly emotional, making it much harder to manage their position with a clear mind. To make it as simple as possible in this situation, the IBD investing philosophy gives you 3 key places you can use as guidance for where to trim back a losing position. There are at least 3 points where you should strongly consider selling a portion of your position when a stock rolls over and starts to bleed red shortly after you buy. Each of these sell rules revolves around the initial buy point, meaning where you sell depends on where you bought initially. We want to make sure that we're buying as a stock breaks out from an official buy point. So, for example, as the stock is moving above a proper base entry, such as a cup with handle or double bottom. Other legitimate entries would be any add-on entries, like buying as the stock bounces from the 21-day line or moves above a 3 weeks tight. Now, let's say you made your initial purchase from that proper cut base and you're feeling good about the stock, when suddenly it begins to reverse lower in strong volume. Your losses begin to pile up. Don't panic. Instead, here are the 3 sell rules that you can rely on to keep your portfolio safe from mounting losses. The first is selling 1/3 of your position as the stock undercuts and closes below the breakout day low. This is fairly simple. We use the breakout day's low as your first line in the sand. If shortly after the breakout attempt, the stock undercuts that low and closes below it, consider taking off 33% of your initial position. The second sell signal comes if and when the stock closes below the low of the day before the breakout day. This is also known as day 0. If shares close below this low, then it's a good idea to perhaps take off another 1/3 of that position. The final sell signal, and the one that's most commonly talked about, is selling as the stock moves 5% to 8% below that initial buy point. Here, we must leave our emotions out of it and follow this life-saving loss-cutting rule. Though it's always tough to sell for a loss and admit that you were wrong, this final hard line in the sand prevents us from suffering a devastating decline that is too steep to recover from. So now that we've laid out these 3 sell signals, let's take a look at an example. Here is a snapshot of oil and gas stock Halliburton, which attempted to break out from a cut base back in June of 2022. We can see how a classic cup was formed over the course of 34 trading days. On June 8th, shares attempted to break out above the 42.60 buy point. Immediately following day 1 of the breakout attempt, shares fell and closed below the low of day 1, triggering the first sell signal. Here, it would have been ideal to take off 1/3 of your initial position. Then, the very next day, shares continued to fall and closed below day 0 of the breakout attempt, or the day before shares broke out. This triggered the second sell signal to take off another 1/3 of that initial position size. Finally, the third sell signal arrived the following day on June 13th when shares broke below the 5% to 8% sell zone from the initial 42.60 entry. This day served as a double whammy, as shares also undercut and closed below the 50-day moving average. And on top of that, the stock declined in heavier than normal volume on that day. This clearly marked the failure of this breakout and gave investors a crystal clear signal to move on to other opportunities. The stock cut right through those key areas of support and didn't stop falling until it reached the 200-day line, where it gained brief support. Investors who finally sold at this level accrued far greater losses than those savvier players who sold at various points along the way. Now, as a rare scenario, you may be wondering, what if day 1 and day 0 have roughly the same low, and those lows are also 5% to 8% below the buy point? Well, in that case, you can scale out in thirds when you're down 3%, 5%, and 8%. That way, your average loss isn't 8%. By scaling out, your actual average loss is going to be around 5% or so, which is helpful for keeping losses in check. Keep in mind the 5% to 8% rule doesn't mean you have to wait until a stock is down that much. That's just the worst loss you should be willing to take. You can act much sooner, and selling in thirds helps you do that. Avoiding making all or nothing decisions can also keep you in a stock if it pulls back a little, but ultimately resumes its uptrend. So, to summarize, Just like with profits, we don't want to leave our losses up to chance. How to exit your losers is just as important as how you exit your winners. We must have definite sell signals we can use when a trade turns sour and our emotions flare up. Again, the 3 strategic places at which you may want to cut your losses are when the stock undercuts and closes below the breakout day's low, when the stock undercuts and closes below day zero's low, and finally, when the stock is 5% to 8% below the buy point. Having and sticking to your plan, especially when it comes to preventing losses, is key to successful investing. Each of these lines in the sand will help you protect your well-earned capital while trying to find the next big winner for your portfolio. When you buy a stock, you want to see an immediate payoff. So if it breaks your expectations, it's important to quickly recognize those signals of failure.